Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy. We're an hour away from the opening trade. Here's what you need to know. The UK clinches the first trade deal with the Trump administration, winning cuts to tariffs on exports, but failing to reverse the 10% flat levy that applies to most goods. Next up is China's turn as the U.S. Treasury Secretary and Chinese Vice Premier head to Geneva, the world's two largest economies, seeking to de-escalate the trade war. Meanwhile, U.S. Commerce Secretary Howard Lutnick warning that other trade deals remain more complicated as the EU prepares retaliatory measures. Lizzy.
Well, happy Friday, Kriti. It's been a busy week. We have got that US-UK trade deal. Now all focus on those US-China trade talks over the weekend. And you can get a sense of the optimism around how they're going to go from the futures picture. So pointing higher on both sides of the Atlantic. Oil higher too. But look at Bitcoin here, past that $100,000 mark for the first time since February. The countdown to the opening trade starts right now.
Friday morning, good morning. So here's the question. Is there any relationship between what we've just seen between the United States and the UK and the United States and China? Because that's the next big thing, as we've just been hearing, on the agenda. Is one a useful guide to the other? Because it kind of doesn't feel like it will be this morning. The markets obviously are on tenterhooks waiting to see what comes out of China and the talks that we are seeing in Geneva this weekend between the United States and China. But I don't know whether or not actually the optimism that seems to have been built up as a result of what we're seeing between the United States and the UK actually is germane to the other conversations we're having when it comes to trade. Anyway, I think that's going to be the conversation that's going to permeate throughout this show. Let's deal with some of the derivatives of what we are seeing out of the UK deal. Let's call it a framework deal between the United States and the UK. And one of those relates to IAG, which is the parent company, obviously, of British Airways. The company out this morning talking about the fact that it is going to be buying or has placed orders for 53 new aircraft from Boeing, which was kind of the big headline yesterday, that we're going to see a kind of a deal being done between British Airways, effectively, and Boeing of the United States, but also Airbus. This is a mixed deal. This actually doesn't really change much of the narrative when it comes to IAG. So is this a big win for the United States? It doesn't feel like it this morning.
Yeah, so 32 Boeing, 21 Airbus. Already, IAG is Boeing's biggest UK customer. But as you say, it's hard to tell how much of a tariff story, how much of a win this is at this point. I think you've also got to look at what happens in the EU deal. We can talk about that later with the US, but Boeing kind of in the middle of all of it.
Yeah, it's fascinating. Let's zero into the UK trade deal as well, or the UK side of this, because one of the key pieces of this, or one of the key hurdles that I think maybe has been crossed a little bit, is when it comes to food exports into the UK. That barrier has come down a little bit, despite some of the details still being kind of in the works. But just that barrier, I feel like, is one positive sign. I guess the question is, if you're not getting much from your closest ally in the world right now, and I think I can say that between the U.S. and the UK, because I don't think Canada's on the U.S.'s good side right now, does that, to your point, set us up for China? And I think maybe there's a question here that because you're so close in terms of the friendship, in terms of that relationship, maybe you don't need to, there isn't that urgency to figure out the rest of the details.
I think on agriculture we have to be very careful about tariff barriers and non-tariff barriers. And with the UK, of course, we're so sensitive to hormone-fed beef and chlorinated chicken. That's really going to spark the headlines. It seems like Starmer has managed to thread a needle here on this US. It's not even a deal. It's a framework to get this over the line. This is manifestly not a comprehensive, full agreement, as Trump was touting. There is a lot to be discussed from here on out. As you say, Kriti, you've still got to negotiate on metals tariffs. They can't even align on what they've agreed on that. The digital services tax, they've still not got to negotiate. But isn't it massive that we've gone from back of the queue under Barack Obama to front of the queue under Trump?
Massive? I'm not sure I'd use the word massive. Anyway, apparently Starmer was watching the Arsenal-PSG game and Trump calls him halfway through, which must have been really irritating, and says, we've got to get this deal done. But it speaks to the idea that Trump needed a win, I think, out of this. And you do wonder whether or not that is the narrative, and that is... we need some positive momentum here, and I think that's what the White House was looking for. And going into this weekend, it sets up, I think, a more positive picture. Trump's talking about go out and buy stocks. It's going to be a great deal. We're going to lower the trade barriers. It's going to be fantastic. But does going from 145 to 50% really move the dial? Because actually it's still at 50% on a Chinese trade tariffs. you're still probably effectively dealing with a trade embargo.
But it is still an almost 100% decline.
But it doesn't matter, because
sure.
you go past the point of which they're so high that you can go from 50% to 145%, you still get the same results, i.e. nothing is moving.
But that's the same point as the UK, where it's one step forward after 2 steps back. And when you've got Bessent saying that, realistically, in private, he's saying it could take 2 to 3 years to get a China deal, how much relief are you going to see for the consumer in the short term?
I think the fact that these talks are even happening to begin with is a big deal, because they weren't a month ago. We weren't having that dialogue between China and the United States. The fact that these two leaders are going to neutral territory, quite literally, in Geneva, is crucial as well. Connecting your very first point that you opened the show with, which is whether the UK trade deal creates some sort of framework for the United States and China as well, I think is also crucial to mention that one has larger repercussions, larger global effects, larger trade effects than the other. And therefore, I think the urgency to have a more comprehensive deal in the UK is not as key to a domestic and to a U.S. economic story than a Chinese deal is. But access to market is really important, because if Donald Trump is talking about a manufacturing economy where you can export, you can't do that with China. You can do that with the UK. And that's where I think the best, or the juicy bit of the UK deal was.
But we even know that it's not that juicy to the UK. We were listening to Andrew Bailey, the governor of the Bank of England, yesterday in the press conference saying, you know, I hope that those many deals that Trump is promising come around, because even he acknowledges that a US-China deal is more important to even the UK than a US-UK.
It's more important to the UK to get a China-US deal. Yeah, exactly. Which speaks to the idea that this weekend is really important. So what is the market setup going into this weekend? The view is that we're going to see some quite positive headlines. The tariff level comes down. But is that a win? Have we already priced that in? Because that's the anticipation. So what's a win this weekend for markets? What gets markets another leg higher? Is that already in the price? What happens if they come out of this and say, actually, we're just going to kind of leave things as they are, we started the conversation, this is kind of the pitch? Is that a negative for what is the setup here? And even if we end up walking away from this weekend with 50%, at some point that 50% is going to end up in the hard data. Nothing is going to change in terms of the actual trade situation. Are more ships going to go onto the water as a result of them dropping to 50%? I don't know. I doubt it. So at some point it's going to show up in the hard data, and at some point the market's going to have to recognise that it is showing up in the hard data. But do we just... I was talking to Val about this earlier. Do we just have to wait until we get to that point? Are we in a kind of period of stasis at this stage until we start seeing the numbers actually being realistically represented in the hard data?
I think that's the key point, that ultimately the 50% may not change the directional impact of where these trade flows are going, or where the tariff story is going. But what it will change is how much these companies have pre-existing trade flows and are still waiting to kind of reorient supply chains. I'm taking an Apple, for example, have to pay up front when a ship comes to the LA port. And I think that's where the other trade deals around the world matter as well, because it's not just a China story, especially when we're talking about, like, the chips, for example. We're talking about oil exports, the likes of South Korea, Japan, the EU even, which was already bracing itself for kind of tumult when it comes to their own negotiations, really plays a role here, because in the absence of any progress on China, or further progress in the UK, you really need these trade deals to come through. And actually, the fact that the UK was the first in line is interesting, because we thought South Korea and Japan would be the first in line. That was something that Donald Trump had said. Those deals are right on the horizon. Howard Lutnick walking that back.
Yeah, and obviously the UK is the crocodile closest to the boat. We can't, the UK, afford to take the retaliatory tone that the EU is taking, and indeed we're reporting that they're going to. You know, they're saying they're going to slap the US exports with more tariffs if the trade talks flop. 95 billion euros worth of them. So it's a very different tone. It shows how much harder that's going to be.
I like the fact the UK is a crocodile. Like, I don't really see us as a crocodile. Not quite so dangerous. Anyway, plenty to discuss this morning, as we've already indicated. Henrietta Packmore is going to be joining us very shortly from Allspring Global. We're going to talk about what the fixed income story looks like around all of this. Elsa Lignos is going to join us from RBC Capital Markets FX Strategy. She's the global head of FX strategy. There is a lot to discuss right now. Has the dollar bottomed out? Hugh Franklin, Mirabeau Asset Management, talking about equities a little bit later. And John Alty, former senior trade official for the UK government, joining us a little bit later on the show. We'll get his take on how we should read all of these relative deals, Lizzie.
Well, we've got a busy day ahead. We've had a busy week for central banks, of course, and it'll all be discussed at the Reykjavik Economic Conference later on today. At noontime, we get the Bank of England's chief economist, Hugh Pill, speaking. Interesting to hear from him after that three-way vote split at the BOE yesterday. If you're a cycling fan, we've got Giro d'Italia starting on Saturday, as well as, of course, as we talked about, the US-China trade talks, really the focus. But also on Sunday, Saudi Aramco earnings.
What else do you need to know this Friday morning, other than the weekend is coming? India and Pakistan say they've shot down drones and missiles over densely populated areas in a second day of military hostilities. Pakistan's army says it took out several Indian drones over cities including Lahore, Rawalpindi and outside Karachi. India says it neutralised Pakistani drones and missile attacks on Wednesday and Thursday, targeting military sites. No casualties reported by either side. President Trump is said to be pushing lawmakers to raise tax rates on some of the richest Americans as a way to offset other cuts in his signature economic package. Sources tell Bloomberg that Trump wants a new 39.6% tax bracket for individuals earning at least $2.5 million or couples making $5 million. Does that mean the tariffs aren't going to cover some of the other stuff? It's only a hint maybe in that. And Cardinal Robert Francis Prevost has been elected as the Roman Catholic Pope, the first ever to come from the United States. Prevost has chosen the name Leo XIV, the new leader of the world's 1.3 billion Catholics. Is seen as a possible bridge between the moderates and the hardliners of the Catholic Church. Prevost was a protege of Francis and previously served as Archbishop in Peru. What do you think, really? First American Pope.
I gotta say, my WhatsApp yesterday when this was announced was wild. Every European rolled their eyes and every American was like, yes, an American Pope, which I thought was quite telling. I think there is a key policy story to be told here, which is simply that Pope Francis had butt heads with the Trump administration and even the Biden administration at points when it comes to the international policy. He's also, of course, had some very forward-looking and progressive stances when it comes to other social issues as well, including international conflicts when it comes to Ukraine, when it comes to the conflict in Gaza, and when it comes to other parts of the world. The fact that this Pope is not only going to be a protege of Francis, but at the same time maybe roll back and kind of be seen as someone who stabilizes those tail risks, as Guy put, I think is crucial at a time when there's a different American in the world who's creating a lot more volatility. This one may be expected to not do as much.
The expectation is that the new Pope will not see eye to eye with the Trump administration.
Right.
I think that is the general kind of overview of all of this. I don't know what it's going to mean in terms of kind of policy coming out of Rome, out of the Vatican. I don't know at this point, but there's a lot of things that need fixing on that front. This is going to be a tough job.
I mean, wouldn't it be good to have a Trump whisperer in the Vatican saying, love thy neighbour in a tariff war?
Yeah. I think your expectations are very high.
Yeah, that's an optimistic
in terms of where that one's going to go. Apparently, Bob. Apparently, he's Bob, and he's a White Sox fan, which obviously is going to upset people in other parts of the United States on the East Coast, like Red Sox fans, for instance.
A man from Chicago. I think we'll leave it at that. Coming up, plenty more to digest in the show. Plenty of earnings that have hit the wire in the last hour, so we're going to dive into the details. Commerzbank's first quarter profit unexpectedly rising as it set aside less money than expected for souring loans. We're going to check in on the German lender at the open. Plus, is this private credit's moment? Global uncertainty seems to be providing opportunities for the sector. We're going to discuss just how juicy the opportunity is. But up next, straight into the markets. How do you trade these U.S.-China trade talks if we do get a positive or maybe not so positive outcome? We're going to get into the market's view shortly. If you have any questions for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Friday morning, good morning. Futures mildly positive. Europe a little bit more than the United States, but we do at least have some green on the screen right now. This is as we go into a weekend, obviously, that's going to be dominated by what happens on the trade front and the talks in Geneva between the United States and China. President Trump says investors should, quote, buy shares ahead of these trade talks, signalling maybe that tariffs could fall if discussions go well.
Speaker Johnson and Leader Thune have done an incredible job. I mean, I'll let you know we have to get a vote, but we have a lot of support for that bill. And if that happens on top of all of these trade deals that we're doing, this country will hit a point that you better go out and buy stock now.
Stock recommendations from the White House, from the Oval Office. I still find it incredible. Valerie Teitel is here to walk us through the reaction to all of that.
Yeah, that comment is incredible. President Trump saying buy stocks now. But I think the message from the market yesterday was really buy the dollar. The dollar had its best session in over a month, Guy. All of this on the back of some trade optimism. And it was those currencies that really benefited from the recent dollar weakness, be it the yen or the Swiss franc, that posted some pretty steep declines in yesterday's session. Perhaps this is giving us a glimpse of how the market could trade a better than expected negotiations over the weekend. It might be the dollar that could be the barometer. But while they're buying the dollar, they weren't buying the treasuries, that's for sure. We had yields rise across the curve yesterday pretty steeply into the close. 10-year yield saw around a 10 basis point rise. A lot of this having to do with a further pricing out of Fed cut expectations. Not necessarily the Fed being the catalyst for that at their decision 2 days ago, but it was more this optimism around trade, continuing to price out expectations for Fed cuts. This chart behind me is the July Fed pricing, so not the next meeting, but the meeting after. It's been really cut in half. It was only last week we were pricing 40 basis points for that meeting. We're now pricing less than half of that, now 17 basis points. So this is all around this trade optimism. Maybe we don't need the Fed cutting as soon as the market expects.
All right, Bloomberg's Valerie Teitel walking us through a little bit of everything there. We thank you so much. Henrietta Pacmont, Global Fixed Income Head at Allspring Global Investments, joins the program now to add a little bit more to Valerie's analysis there. Pleasure to have you on the program. We're going into a very exciting weekend. Valerie just ended on the Federal Reserve, and I think my first question to you is, does the Fed even matter right now when you're looking at trade front and center?
At the moment, the Fed is a taker of what's happening around the market. Obviously, they are very subject to the trade talks. Obviously, they're keeping an eye on inflation. And at the moment, why they're holding back in terms of cuts is that they're not sort of seeing an impact in terms of employment. I think that's where you sort of start them seeing getting more anxious and maybe moving. But they're takers at the moment.
I'm going to ask you a slightly nerdy question, and then we can go more into the kind of the trade dynamics as well. I had a conversation with someone this week who has said that one of the big concerns, especially going with the U.S. and China and Japan, which we kind of know, is this potential dumping of treasuries if it's on the horizon. If in that kind of worst-case scenario that does indeed happen, do you see, or the folks you're talking to see, enough domestic U.S. exposure or domestic U.S. demand, whether it's from the indirect dealers, the banks, et cetera, or even just kind of fund managers, to kind of mop up some of that excess liquidity?
So it's been really interesting to watch. Since the beginning of the year, there was one day in particular where you started to see a bit of a dysfunction in the Treasury markets. And I think that's when Trump actually pulled back, and that's when the Fed sort of started to step in. So I think that is an area that is hugely sensitive. You want a functioning bond market. So if you're starting to see cracks there, I think the sort of playbook changes, and we've seen that once since the beginning of the year.
So to the UK, which certainly knows a thing or two about cracks.
Exactly.
Yes.
Precisely.
What was the message yesterday from the Bank of England? Was it useful? Was it useful for other bond markets? Do you think we are slightly too far down the road in pricing lots of cuts out of Europe, not just for the Bank of England, but maybe for other central banks as well?
I think you've got a different dynamic between the Fed and other central banks. I think the Fed is dealing with the trade situation and maybe a more likely impact from an inflationary perspective in the US. I think that's a different case when you started looking at other central banks. So I think at this point they've got a bit more leeway. They're probably a bit more anxious about growth. I think my slight surprise out of the Bank of England yesterday, it was probably a little more on the hawkish side than I thought it was going to be.
So what is that? So why? Why do you think that was? Is there a message from that hawkishness?
I think the UK may be less of an impact in terms of reading the global path. But I think the takeaway for me is if you look at the hard data, and that what we're seeing at the moment is pretty robust, right? And maybe more robust than people thought. Things take time to play out. And I think that's what we're seeing at this point. The economic data is not bad. Sentiment's taken a hit, but it's not hard data yet.
Well, exactly. As we go from that UK deal into US-China talks over the weekend, how positive are you feeling? Is the market too positive this morning when we're reporting that all they're going to do is air their grievances in Geneva?
So I think why we're seeing enthusiasm from the market at this point is a step in the right direction. After a tough couple of months where we were going in the wrong direction, we're starting to see progress. So I think that's where the enthusiasm is coming. We were talking about it just before coming on air. It's going to look optically good, even if it's a sort of 50% cut, but it's still very high. And we haven't seen the sort of play out in the real economy, really, of the impact of these tariffs. And I think now we're going to have to sort of see the speed of negotiations versus the speed of pain that's going to trickle around on the economic side.
But, I mean, as the weeks go by, are you taking comfort from the sense that there is a limit on Trump, whether that's empty shelves or the bond market?
I think exactly those are the two things that are holding him in check. It's not a good look if you have empty shelves. I think he's going to be sensitive to that. It's not a good look if you have volatility on the bond market. That being said, compared to Trump 1.0, his tolerance is a lot higher this time.
It's a twofold question, if I can. One is the optimism around this, whatever we may get, the optics around it that may look good, priced in. And if so, to what extent? What does priced in look like here in the bond market?
In terms of what we're looking at going forward, I think it's continued progress. I think that this weekend is a first step, but I think the markets are going to want to see, okay, what's next? It needs to be sufficiently tangible to continue some of the corrections that we've seen over the last few days.
Does that just kind of leave us range-bound then when we're talking about yields?
I think that's fair, right? How we're playing it in our portfolios is that we're keeping a fair amount of flexibility, so that when we see distortions in the market, and probably playing it more on the relative value side of things than sort of outright bets at this point in time, that's what we're looking for. So looking at ranges, looking at distortions between relationships, and trying to play those over time.
What does optionality... Optionality means more cash, right?
It means not extending your risk budget so that you've got flexibility to move. Examples of trades that we've been doing since the beginning of the year is looking at relative value on the credit side between Europe and the US, right? Yep. That's changed around. So we've been moving our positions out there. We've been looking at relationships between different rating types, triple Bs, double Bs, and sort of playing in that range. So it's making sure that you haven't got a stretched risk budget at this point, looking at relationships between asset classes,
nothing too directional, though.
Nothing too directional, and keeping risk budgets under control.
Okay.
Well, when you look at Europe, just briefly, after Merz's rocky start, how are you feeling about here? Germany.
So it was interesting. We talked about Germany last time I came, and there was a lot of optimism because they just announced the package in terms of investments over the next few years. I think it was an interesting exercise to see, and I think it just shows that it's going to be tough to get that investment out in Germany. So good, but a negotiation.
Okay. Henrietta Packmont, Global Fixed Income Head at Allspring Global Investments. Always good to have you around the table. We thank you this morning. Coming up, tariff turmoil and the dollar. We'll discuss the fallout with RBC Capital Markets FX Strategy Global Head. This is Bloomberg.
Chip company.
30 minutes from the start of the opening trade, and you're looking at futures pointing higher on both sides of the Atlantic, only marginally higher stateside. And here in Europe, it's the CAC 40 and the FTSE MIB in Italy that are set to outperform. Euro Stoxx 50 futures up 0.4%, Kriti.
In the meantime, a quick check on these bond markets here. I'm looking at a 2 basis point jump over in the French OAT as well. German 10-year around the same. We'll call it 3 basis points. We want to round up there. The Italian 10-year high by 2 basis points as well. So a few basis points higher. Slight sell-off in the Treasury market right at the open. We'll see if that sticks, Guy.
Yeah, I'm going to watch gilts this morning. It'll be interesting to see what they do after a big move yesterday on the back of what we saw from the Bank of England. Tariff uncertainty, though, is the main story of the morning. We're trying to figure out what is going to be happening next. We did see a big dollar move yesterday, a positive dollar move. But the movements that we've seen over the last month or so with the dollar weakening, already starting to have an impact in terms of the corporate earnings that we are getting out of Europe. Yesterday, I had a conversation with the CFO of the German chipmaker Infineon, talking about the impact that even small currency fluctuations are having on his numbers.
I've given up in really making currency predictions. It's not possible. But the magnitude is we have this rule of thumb that per every cent to the dollar change, we are winning or losing, depending, of course, on the direction. 25 million of revenue per quarter.
Per quarter, 25 million per quarter per cent move, basically, is the rule of thumb that Infineon operates with. That's the chip sector. Obviously, it's got big exposure around the world into the United States. Elsa Lignos is the global head of FX strategy at RBC Capital Markets. Elsa, we're seeing corporate after corporate at the moment talking about the impact that the foreign exchange story is having. We've seen a big move against the dollar. What are you, when you're talking to corporates, when you're talking to businesses at the moment, what are you telling them about what they need to be doing and whether or not this move has legs, whether or not it's something that they should be hedging against, and what kind of feedback are you getting from them?
So it's interesting because US corporates have obviously had to deal with this for quite some time, given the strength of the US dollar.
Yep.
And they've had a long period where they've sustained that dollar strength, come through out the other side of it, and now we're almost coming into the reverse dynamic. We did have that very sharp move from 104, 105, all the way up to trading above 115. We seem to have stabilized now around 112 to 114. And I think a period of consolidation is due. But the longer-term direction, it's hard to fight an expectation. It's pretty consensus, but I understand why, and I actually subscribe to it myself, that euro-dollar heads higher from here. And not because, it's a massive liquidation of dollar assets or anything like that, but because it's a rotation that makes sense. And also, as the Fed eventually is cutting rates to more European-type levels, you should get hedges being put back on US investments by European investors.
So what do they do now? They just have to suck it up? Can you hedge it now? Should you be hedging it now? What is the advice that you're giving?
So we are seeing more European corporates hedge out their exposure. And on top of that, you're seeing US corporates perhaps slightly reduce their hedges, to take advantage of some expectation in a decline in the...
Does one offset the other?
I'd actually focus more on the investor flows rather than the corporate flows.
Okay.
Reason being that you have this huge stock of US assets held by European investors, over 6 trillion euros.
Unhedged.
So actually, if you think about it, the hedging decisions on that stock of assets is going to swamp anything we see on the corporate side.
So can you just expand on why U.S. corporates are choosing to pull back on some of that hedging? Is that just a question of scale?
So on the US corporate side, they've been in this position where they've had to deal with dollar strength for a very long time. To be fair, most corporates do have some quite systematic hedging programs. Well, they'll hedge out several years opportunistically and, look for the levels within the range. But you're rarely going to find any corporate that's entirely unhedged, any large corporate that's entirely unhedged. It'll be more about tactical hedging decisions within that broader outlook.
And is that specifically in relation to the euro, or are you seeing more of those moves, especially when it comes to U.S. corporates, start to angle against the yen, the Korean won, the Chinese renminbi? Are we starting to talk about more of the Asian FX hedges come to the forefront?
I mean, Asian FX hedges have been massively in focus this past week, right? Again, more from an investor perspective than a corporate perspective. Typically, you find that where it's cheap to hedge, there will be a kind of a natural bias towards hedging more. I think what corporates are finding most challenging at the moment, and this is particularly true for US corporates, but we speak to Canadian corporates that have a very similar issue, is predicting their earnings, predicting what sales are going to look like over the next year, just given the tariff uncertainty. That's really causing the most cause for concern rather than the currency moves themselves.
What do you make of those Asian currency moves this week? If we look at the Taiwan dollar, do you expect more of that kind of... do you expect to see currencies used more as a negotiating tool in these tariff talks?
There is certainly a lot of smoke around what's been going on behind the scenes in terms of talks, right? And it's fair to say that, a lot of people jump to the conclusion that where there's smoke, there's underlying fire. But alongside of that, the Taiwan dollar has been very cheap by pretty much any valuation metric for a very long time. And when the entire market is very much one way, it is always dangerous that you're going to get a very sharp move in the other direction, catches people out, and then it's self-reinforcing.
Yeah, but of course it's central bank managed, and that weakness helps, right? But, interesting to see whether it gets used as a negotiating tool ahead. I also just want to pick up on the pound, because, of course, it went on a bit of a journey, given not just the BOE decision yesterday, but then the tariff talks ahead. How do you think it'll play out in the future? Because, we were talking about how hawkish the BOE was, surprisingly, yesterday. Does that kind of get drowned out when it comes to cable because of any progress we get on US trade talks?
I mean, hawkish on the one hand, but at the same time, we did hear that they're fairly comfortable with market pricing for terminal rate. I do think that the trade deal is minor in terms of the impact it's going to have bilateral trade relations. The UK, of course, is one of the few countries that actually runs a trade deficit with the US. And I think the UK is going to be far more exposed to the second-order effects of what tariffs globally do to growth, rather than bilaterally between the US and the UK.
Can I just come back to the main point, which seems to be coming out of this conversation, which is investors that are unhedged, the big dollar moves are going to cause problems, and we may see further still to come on this front. Talk to me about the order of magnitude that we could be potentially seeing here. You've got all these unhedged assets in the United States, the dollar's dropping, Asian investors in particular, but European investors as well, are getting pretty jittery right now. Do you have any idea of the kind of scale and the magnitude? Are things going to break around this? How big a problem could this be?
I don't know if I'd call it a problem per se, because we've had very large currency moves over many years. And, it's not a cause for panic. I mean, I think there was that brief moment of panic around April 10th, 11th, where the dollar and bonds and equities were selling off together. I mean, that's highly, highly unusual.
But currencies tend to go nothing, 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 and then a lot.
Yeah.
And I'm wondering if we're heading for another a lot moment, which could cause problems.
Yeah, I mean, what we're seeing now is more of a consolidation. And actually, yesterday, the close, just from a technical perspective, and I rarely talk technicals, but our chief technical analyst, George Davis, was really big on kind of watching for that short-term top in the dollar. And the fact that we closed below 112.73 and we now appear to be pulling back, it does point towards a kind of correction, retracing from overbought levels. That's actually a good thing, because that implies basing for a more steady up move. And ultimately, it will come when the Fed is ready to cut rates. I mean, we heard from Chair Powell this week. They're in wait-and-see mode. They're in no rush at all. So ultimately, this could actually take many, many months to play out, 12 to 18 months, potentially. That's not going to be a rapid, scary move.
But what about the... As Guy was saying, bracing for that kind of a lot moment in a currency space, does that come from, or perhaps stem from, this kind of yield differential that we're starting to see, but almost create a larger divergence between what the bond market is doing and what the FX market is doing? Conventional history would suggest that one has to snap back into kind of into focus. Which one snaps first, the bond market or the FX market?
So also, when you're talking about yields, it depends where on the curve you're looking. In a crisis-type moment where you're worrying about liquidation of dollar assets, then it's the 10-year that I think people will naturally focus more on. Sure. But actually, the front end, over the long run, is more impactful in driving those hedging decisions. And we had seen a period where Eurodollar was kind of diverging from front-end rate differentials, and you were seeing more of the kind of, unwind of the dollar long position, swamp everything else. But I do think if you look at it over a 12 to 24-month horizon, which is the one that's most relevant for long-term investors and for corporates, you will see those hedging decisions being driven by very front-end yields.
But in an environment, which I think we've just seen, where your international investors have, at least from a narrative perspective, gone anti-America in terms of assets, pulled back on the dollar, but are bracing for an inflationary impulse, how sustainable is that kind of opposite kind of sky to earth move?
It's really interesting, because I agree with you. There's definitely that narrative. But actually, if you look at both relative equity performance between the US and Europe, but also, track ETF flows, for example, there was a wave of money going from the US to Europe from the election all the way through to about mid-March. After the German fiscal announcement, it really got another leg higher. But it's actually stalled a bit since then. I mean, in part, I was discussing with our great equity strategist, Laurie Calvasina, you've got the tech sector, which, though typically is seen seen as a kind of growth sector, in a tariff situation is actually seen as a bit more of a defensive play.
Yeah.
So I think the narrative is out there that this is all about rotation from the US to the rest of the world. It's not quite so clear that the flows are backing that up in April and May.
Oh my gosh, fascinating conversation. So many asset classes intertwining, more so than regular. Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets, joining the program this morning.
OK, what do we got coming up? British Airways parent IAG set to buy 30 Boeing jets in a win for the United States. It's also buying a few Airbus jets in a win for Toulouse as well. Anyway, we'll bring you that stock story. I think they're buying a few more than anticipated, not changing guidance either. We'll talk about our stocks to watch next. This is Bloomberg. 15 minutes to the market open. I just want to take you to what is happening in Moscow. Obviously, ongoing celebrations around the world of the end of the Second World War. Vladimir Putin is currently greeting leaders that are gathering in Moscow for that celebration. And we are continuing to see a series of them. We've just seen Sisi, we've just seen Maduro, as we continue to watch Vladimir Putin as he gathers an interesting collection of leaders, let's put it that way, from around the world. Anyway, we will continue to keep an eye on what is happening there and maybe bring you some of the more interesting shots that we are watching. In the meantime, Kriti's got our eye elsewhere, maybe on Omaha and Idaho and what is happening in the United States. What are we looking at here? Kriti, over to you.
Yeah, it's going to be a fascinating one, especially when we talk about kind of not just the Oracle of Omaha, which is where we started the week, Guy, and I think that's really crucial as well, in that we talked about where Warren Buffett and how is thinking about where to put his money in this economy, of course, at the helm. But it really, I think, signifies kind of the sentiment that we're talking about in the end of the week, which is this a moment to be optimistic, whether it's the trade story, whether it's the Federal Reserve story, whether it's even just the fact that maybe the selling is over. So I'm going to give a little bit of an ode to the Oracle of Omaha and bring you this chart that caught my eye, which is called the Buffett Indicator. It shows the ratio of basically the U.S. stock market value to the entire GDP of the country. Now, I'm going to show a very long-term chart here and then walk you through it. I'm going way back to 1999, but every time this chart hits a record high, it has historically signified a major pullback. So an example here goes back to 1999 in 2000, where you're not necessarily seeing the expansion in GDP that would match that market value. You see the same thing going all the way back and all the way to 2021, then followed, by the way, by 2022 and that massive year of sell-off. So look, there's other pieces here to this as well, but note that we are right back at those levels and have come down a little bit. Now, critics of this particular indicator are going to say this is a chart that does not include interest rate differentials, trade negotiations, and certainly the Trump effect, because, hey, we've never actually had one to that extent beyond that his first administration show up in this chart. But if you are listening to the Oracle of Omaha, he would point to this chart and say it's a time to buy, Lizzy.
OK, time to buy. And we are looking at futures not much higher this morning, Guy.
But President Trump says we should be buying stocks.
Indeed.
I buy stocks ahead of this weekend. It's going to be this weekend that is going to define what is happening here, and you want to be buying stocks ahead of it. Let's get the take of our Markets Live executive editor, Mark Cudmore, on this. Mark, the President of the United States is giving stocks advice. Should we be listening to him?
Yes, probably. I think he's guiding that he wants this weekend to have positive headline risk for markets. He is the most powerful man in the world. I think that's often can be said about the US president, but for markets in particular at the moment, because the biggest story in markets is Trump's trade policy and what he'll do around that. So he is the most important person to listen to. It doesn't mean he'll 100% be correct, but I think he is certainly very much pushing for a positive headline out of this weekend. What will that be? Well, the expectations from the markets are that we're going to see severe de-escalation between US and China. And, you know, what people are really hoping for is we get some kind of pausing of tariffs or some kind of reduction of tariffs while negotiations are ongoing, and just some positive messages that they are on track to backtrack significantly from the threats of a month ago.
I mean, that might be what the market's hoping for, Mark. But Sean Donnan, our trade reporter, is saying that they're just going to air their grievances. You know, if we get a Zelensky moment in Geneva, harking back to the Oval Office, what happens to the market then?
I think, actually, the sound bites out of the weekend are less important than what they practically decide to do on tariffs for the negotiation period. So no one has real high expectations of anything concrete coming out of it in terms of course, we can't get a trade deal instantly. It's just going to be talking, as you say, about their grievances, maybe outlining what the first steps are for talks or for a framework, etc. However, the big thing to watch is if the US decides to say, look, we're going to pause tariffs on China or we're going to reduce them to 10% while negotiations are ongoing, or we're going to delay them for another 90 days because of positive messages, then it doesn't matter how negative they are or how grumbling they are. That pause is what the market is looking for. So that's the thing we're really looking for this weekend. Do they kind of pause or delay tariffs and provide that kind of gateway? And that'll happen no matter what the sound bites are. And because Trump is promising something good this weekend, there's a high likelihood we get some action like that. And if we don't, the market will be devastated on Monday because market expectations are very optimistic for something positive to come out of the weekend.
Well, Mark, lean into that doomsday message, if you will. What happens on Monday morning in terms of that market ripple effect if they don't get what's priced in right now? What kind of market price action are we looking at?
If we don't get a pausing of China of tariffs or some kind of reduction of Chinese tariffs or a delay or a sign that's about to happen imminently, I think global markets will be hit very badly on Monday. It's particularly bad for US stocks and Chinese stocks, but being the two most important stock markets, it's going to ripple around everywhere. So I think, go ahead.
Okay, just Mark, the other side, how much of the good news is already priced? We've known that this has been coming for a little. I'm trying to sort of. I don't know how the symmetry works here. There's a lot of bad on one side, but how much good is there on the other side, considering we've already anticipated that there's some good coming?
I think that the structural story remains negative because the damage that is being done regardless of what we get out of this weekend. So if we get a positive headline this weekend, which Trump is guiding towards and wants to deliver, we get a serious squeeze. But it's a squeeze that will be sold into. It's a squeeze the Sell America trade. It'll be very punchy in the short term. But the fact is, the price of doing business for American corporates is rising significantly from months ago. And the policy uncertainty around the US has risen significantly. And the lack of enthusiasm to do business with US corporates has risen significantly. All these things remain the same. So you're going to get a very powerful squeeze and a positive headline, but it will be sold into. We're still going to have problems. We're still going to have the stock market probably lower in a couple of weeks from now, or maybe even 2 or 3 weeks from now. I think it'll happen quite quickly. We'll fade that, even though the initial move will be quite powerful. On the other hand, if we get a disappointing headline this weekend, well, then we just trade that bearish story very aggressively until Trump is forced by the market to backtrack again.
All right, Bloomberg Markets Live Executive Editor Mark Cudmore joining the program this morning, laying out some of the scenarios going into this weekend. We thank you so much. Get more up-to-date analysis from him and the team. ML Ivy Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So IAG's numbers looking really strong in terms of the British Airways owner. Interestingly, in the statement, they're talking about strength in premium cabins, so business class and first class, making up for weakness in some of the economy leisure, according to the company. But we can see that massive rally the back end of last year, the stock almost doubling on strength in the North Atlantic business. So potentially this might already be factored in. It might limit some of the upside we see in that stock. Today, then, I'm also looking at Commerzbank, beating expectations pretty much on every metric. The net income looking really good at the German lender. That stock pretty much rallying in line with the stocks banks index over the past few years since interest rates started going out, actually outperforming quite significantly on a percentage basis, up around 300% on a 3-year basis. Pretty good. In terms of that one, we'll see where that opens up in Germany. Then in terms of Campari, the maker of Aperol, weakness once again at the drink company, saying they've seen a soft start to the year in the first quarter, as expected, amid a backdrop of heightened macroeconomic volatility, according to the Italian company. However, this stock has lost around half of its value in recent years. We can see they're down 50% following several profit warnings. So potentially it's another one where this might actually be priced into the market. Potentially we are seeing some calls lower. For that one, keep an eye on Campari in Italy later today.
Okay, Joe Eason, our equities reporter, we thank you. We are looking at European futures, pointing higher still, up 0.4% on Euro Stoxx 50 futures. Not so good for FTSE 100 futures. CAC Cajon up 0.5%, same for FTSE MIB in Italy. Lots of Italian banks reporting this morning, got to factor that in. Some other earnings just to factor in overnight. Enel profit boosted by the good performance in Latin America and Spain. And you had, of course, Joe mentioning the IAG and Commerzbank earnings as well already.
Yeah, today's wait and see, isn't it? What do we do today? Do you either take Trump's advice and load up on risk going into this weekend, anticipating that we are going to get some sort of a deal, or you go, I have no idea, and the outside risk of a nothing happening on Monday morning is huge. But so you got a big risk over here, you got a sort of moderately upside risk over here. How do you balance that out? What do you do with risk this morning? Do you load up? Do you take Trump's? I don't know. It's going to be really interesting to see how the market trades this one into the weekend. In some ways, you'd want to take risk off, but in some ways, there's actually got a big risk-on move into the weekend as well.
It is 100% a positioning story from top to bottom. When you look at the S&P 500, it only closed higher by 0.6% yesterday. So that, to me, screams skepticism right out of the gates. I'm looking at U.S. futures this morning. Europe is actually maybe a little bit more positive, maybe catching up a little bit.
A little bit of a catch-up trend,
yeah, showing up there. But you look at U.S. futures, it's only higher by 0.1%. I'm going to go ahead and call that a flat move overnight. So, again, skepticism across the board.
How much is already on? You see a decent move. So over the last few days, how much is already in the market?
And that's just the equity market. We're looking at a bond market here at 436. We're on that high kind of echelon of the range that the 10-year has been trading in. The dollar, I think, is crucial here because that's where I think you have perhaps the biggest risk right out of the gates. But, of course, we are about 5 minutes away to the European Equity Open. We're going to dive into the details there. How much of it is a micro story or a macro one? This is Bloomberg.
Friday morning, we're almost there. Except you've got this whole kind of thing going on at the weekend, which you probably need to factor into your thinking this morning. China and the United States talking in Geneva. Yesterday, the President of the United States suggested buying stocks. The market maybe initially listened, but then definitely faded the move into the end of play. So Europe went out here, not too dissimilar to actually where US markets finished up. Futures are a little bit higher in the US this morning. Futures are a little bit higher in Europe. Not by much, though. Kind of feels like the market's a little bit nervous going into this weekend, despite the advice of the President of the United States, Kriti.
But is Europe processing that first half of the U.S. session or the back half? I can't quite tell there. And this is, I think, what's crucial because you are seeing a move higher in futures going into the weekend. That is unusual for Europe. Usually it's a Friday. Usually it means risk off going into the weekend risk. You're not seeing that. So maybe Europe listening a little bit to Donald Trump, having a little bit of a catch-up trade. Only higher by 0.3%, though. So, Guy, let's see if it actually sustains through the European session. The outperformer this morning, though, Lizzy, is over in France, higher by 0.5%.
Yeah, look, Kriti, it's definitely a trade day. That is what's dominating sentiment this morning. But there are a number of stocks that we need to watch off the back of earnings. IAG coming out with strong numbers, talking about strength in the premium cabins. Commerzbank beating expectations on every metric. Net income looking especially good. And we've got Campari as well, but not such a positive story there. A miss on sales and a miss on EBITDA as well. A few ex-dividend names to watch this morning. Allianz is one of them. But, Guy, we're heading towards the open.
We are. 20 seconds to go. A little bit of an orange twist into the weekend with the Campari numbers to think about. But what we are watching definitely is what is going to be happening in Geneva. That's the trade. In some ways, everything else doesn't really matter. Some of the single stock stories are going to be interesting in terms of the overall picture. IAG is interesting. The positive story on the transatlantic certainly helps. Echoing sounds coming out of Tim Clark, I would argue, over at Emirates as well on the premium story. But here we go. The Friday trade is almost upon us. Trade being the operative word. The FTSE 100 absolutely flat as a pancake right now. Not much movement after the trade deal that we saw yesterday, or may I mention the Bank of England as well. So not much movement there. We'll keep an eye on what is happening on the broader picture with the Stock 600. It is up by a measly 0.1%. Market doesn't feel like it wants to have a strong sense of direction this morning, certainly at an index level. Single stocks might be a little bit different, but it feels like it's a macro rather than a micro day. The IBEX is up by a staggering 0.1%, but the DAX actually out early, up by 0.5%, and the CAC 40 is also up by 0.5% as well. So the German market and the French market, a little bit of outperformance coming through this morning, Lizzy.
Yeah, break it down by sector across the continent. You've got about 3/4 in positive territory this morning. So energy leading the gains at the moment. That's up 0.7%. You've got autos and parts not far behind, up 0.6%. Middle of the road banks, and we talked about Commerzbank beating expectations across the board, really. Commerzbank shares up 0.7%. Bottom of the basket, though, insurance and real estate, as well as telecoms this morning. But generally, positive sentiment as we head towards the weekend, Kriti.
It's fascinating here because when we talk about the individual movers, right off the bat, I'm seeing a reversal of the move we've seen in the last couple of days in terms of the healthcare story. And I think that's crucial because we've seen Novo Nordisk take a hit. We've seen AstraZeneca. I mean, 24 hours ago, this is the exact conversation we were talking about. They are your biggest index gainers this morning in terms of contribution. I think that is going to be a crucial piece. I don't want to dive into details too much. I imagine Joe will do this later for us. But BP also higher by about 1.8%. Some drama in terms of what the deal making behind the scenes may actually look like. And I imagine Glencore probably taking its cue from that story as well. And then a slew of Italian banking earnings that are actually kind of in the positive direction. So Guy, I think outside of the sentiment story, there's a couple of earnings and sector stories that are also perhaps positive.
The BP story, I think, is interesting, and certainly the noise is gathering around that narrative of a possible takeout. Shell is up, BP is trading higher as well, but you've also had a move in the oil price, which you want to pay attention to too. So that's moving that sector quite significantly. There is a little movement in some of the pharma stocks, maybe a little bit of a reversal, maybe an opportunity around there. Novo and Roche are both higher. There's some ex-dividends at the other end, so I'm not going to get too excited about that. But this is a market, let's take a step back. This is a market that's got 428 up, 149 down. There's enough down to basically balance out the up, which is interesting. So some of the bigger stocks are seeing some weakness. And it's fascinating. The market's going nowhere. This is not a market. This is not an equity market here in Europe that I think has a clear sense of what is going to come out of this weekend, that has a clear sense that you want to take that risk trade on board and talk about the idea that you are going to see some sort of bounce on the back of anything positive happening. Is the risk of something negative happening or nothing happening just too big to keep everybody on the sidelines at the moment?
So you have no idea. I have no idea. The market has no idea. Let's see if our next guest does. Hi, Will Franklin, head of European equities at Mirabad Asset Management, joins the program this morning, joins us around the table. Pleasure to have you. You've picked a great day because... Good
morning, Kriti.
Good morning. As in, it feels like nothing's happening, but everything's happening at the same time. So what do you do with risk going into a weekend like this?
So, Kriti, I think one of the key things right now is investors are trying to work out, what does it mean? What is, Trump's real strategy here? And, what's the kind of, what's the way forward? And for me, what's really critical is we've got to look at what kind of expectations are embedded in the market now. If we look at investor positioning across the board, it's clear we're still really heavily skewed towards the US. The US is still on very high valuations, kind of 20-plus times earnings if we look at this year. And we've seen it recoup a lot of the losses, since Liberation Day. And for me, one of the key things is really for Europe, expectations are still quite low, valuations are still quite low, and irrespective kind of what comes out of the weekend, it's clear that there is a bit more scope for maybe things to go a bit more right in Europe, and people are starting to question, still the environment around US growth and some of what the impacts will be of the trade negotiations. So, for me, in short, we've got finely balanced kind of expectations in the very near term, but in terms of the level of valuations in markets, there's a much stronger signal there.
So what is, we'll just ask a broad question here, take it where you will. What's the secret sauce to alpha right now?
The secret sauce to alpha, yeah. I mean, if we could bottle that, we'd all be doing quite well. I think, for me, again, one of the keys is really taking a longer-term perspective. We've got some areas of the market which have really driven very strong long-term performance, and which are now really under the cosh. So if we take a long-term view, as we mentioned...
Give us an example. Give us a sector. Give us a... some direction here?
Okay, right. So what really stands out is the smaller end of the cap scale for us. So, we've seen, as I just mentioned, Europe looking at a big discount to the US. What really jumps out is the small end is really trading at financial crisis levels of discount relative to the large caps. And so while we've seen, sentiment starting to improve in Europe, I think, the DAX is up, almost 30% if we look at it in dollars year to date.
Yeah.
We've still seen people have started to reinvest in Europe, but the smaller end is just starting to catch that bid.
Yeah.
So that's one of the areas we find quite attractive.
If we zoom in particularly on the UK, does all this progress, being the front of the queue when it comes to the US, getting the India deal as well, does that actually make any difference when it comes to your view on UK equities, or does it even matter?
So, Lizzie, I think one of the things we've been worried about in markets, just this uncertainty. What's the kind of the end point as far as the UK is concerned? There is just so much skepticism priced into that market if we look at it in global terms, and getting a bit more certainty about what the kind of off-ramp looks like, what the environment will be for companies to invest in. I think that's got to be good for UK equities, for European equities, because there is just so much risk priced in there. So yes, I think the trade negotiations and the agreements are going to be good for sentiment towards the UK and Europe more broadly.
Is US exceptionalism over?
Well, I think if you look at what's now being forecast, let's think about the underpinnings of US exceptionalism. It's all been about stronger growth rates, a more dynamic economy, innovation, and the role of the US dollar. And actually, we're seeing some of these key planks starting to be eroded, guys. So I think, if we look at now the fact that we've got the Fed being questioned, the judiciary system being questioned in the US, and we look at forecasts for Europe starting to converge a bit more to the US, there is a real question now in investors' minds about whether they should be as heavily invested in the US. And if we look in global terms, that weighting of the US, that exposure of the US, which investors have, is at really quite unprecedented levels still. So what we see when we're talking to clients is that there are a lot of them who are wondering why they want to have 3/4 of their eggs in that one basket, and whether it's not time to consider other areas.
Hywell, thanks very much. Thanks for joining us this morning. Hywell Franklin, Head of European Equities at Mirabaud Asset Management. Core 6 looks like this morning. Let's take a look at how the pharma stocks in particular are performing. As you can see, you've got some upside in pharma. It's quite decent upside. LVMH also rising quite nicely. You do see some mild weakness maybe in some of the chips this morning. ASML's a little softer. But broadly, this is a market that feels like it's slightly on the front foot, tiptoeing onto the front foot as we wait to see what happens this weekend. Let's talk about some of the other stocks we're watching so carefully this morning. Joe Easton is here with the detail, and we start with IAG.
So IAG pretty volatile at the open of trading go. We're actually edging higher into the open now, coming down pretty significantly, actually losing around 1.3% at the moment. Now, we did have that big rally at the back end of last year, of course, and also some of the comments around the premium offering, the first-class, business-class cabins, as Guy mentioned earlier, not the first airline to flag strength there, so potentially some of this just priced in. But overall, the earnings were looking pretty good, and of course, we did have that big news around the plane order as well, so potentially that factored in. But IAG kind of surprising a little bit, coming down very slightly today, around 1.6% at the moment. Then in terms of Commerce, that was a beat across the board, as we said, particularly in the net income level, but it has had a decent run over the past few years, actually rising around fourfold on a 3-year basis. We're only up around 1%, but still not a bad return for that one. Then more misery for Campari. The stock down once again. Already was down around 50% over the past couple of years. Another week update warning of softness, not drinking enough Aperol Spritz. Of course, probably not the right season. Well, maybe coming into the right season for it at the moment. But the Aperol maker hit again, warning of geopolitical and macroeconomic uncertainty weighing on the drinks market at the moment. Then take a look at Bavarian Nordic. This is the best performer today over in the health space. Only around a 2 billion market cap, but this is the vaccine maker. Did well on the Mpox vaccine, and a strong update from them once again over in Denmark. That one really rallying. We're up 13% for Bavarian Nordic today. And then finally, just to end on BP, as was mentioned earlier on a few moments ago in the show. So the latest news on this coming from the FT, a report saying that other companies, including ExxonMobil, also Total and even ADNOC, potentially looking at just how this stock is developing in terms of whether it could then be a takeover target. Of course, we had the Bloomberg report of Shell looking at this over the weekend, and looks like a little follow-on, and also the higher oil price as mentioned. But BP up 1.4% in London this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers. Coming up on the program, we're going to continue the conversation around the corporates and dive into more of the earnings. A boost for Commerzbank CEO as she tries to fend off a UniCredit takeover. We're going to dive into the results from the German lender and some of its Italian peers. This is Bloomberg.
Welcome back to the opening trade. We're 15 minutes into today's session, and it's green across the screen for European equities. The stock 600 up 0.4%. Outperformance in France and Germany this morning. But if we flip over to the bond space, gilts outperforming this morning. Well, they have been. Earlier on, they'd been up 4 basis points on the 2-year at 3.97%, the highest in 3 weeks. It's down now, so we're at 2 basis points higher at 3.95%. Really, yields higher across the curve, across the continent, and it feels like it's a follow-through, surely, from the risk-on mood yesterday because of Trump saying, you know, buy stocks, we're going to get progress on the US-China trade talks. You're seeing the read-through here, and, of course, the BOE move yesterday.
Well, the BOE, gilts, you would have thought, would be underperforming right now, which is the logical trade. So they continue to do so. Yields are higher, prices are lower. We're trying to figure out kind of where we go ultimately with the Bank of England. What were they trying to signal yesterday? Was it a more hawkish tone going forward? Do ultimately, if the data turn lower globally, do we see the Bank of England being forced to make more aggressive cuts? There was talk of 50 basis points yesterday, and we ended up with completely the other end of the spectrum, which is a much more hawkish split. The governor always talks about the fact that the split is a mechanism for communicating. What were they trying to communicate yesterday? Well,
surely he says that it's not a mechanism of communication.
He's told me that it is, but OK.
I think it sometimes is when he wants it to be.
Yep.
Look, I think it was hawkish in that we didn't expect people to be voting to hold.
Yep.
And actually, if you look at the minutes, were it not for Donald Trump, they would have held. And so, actually, you know, this is something that's an imported problem. It's a temporary problem, hence why it's a Trump cut. And the fact that they didn't even change the guidance was, you know, that was going to be another dovish twist. That didn't happen, hence why I think the market read it hawkishly.
I'm looking at a cable right now at 132. I feel like is...
The pound in theory should get stronger from here, right?
Exactly.
That should be the trend.
And because especially when we're talking to Elsa Lignos about this, about kind of the dynamics that are potentially driving the euro higher and the positioning there, the pound isn't necessarily a part of that trade, although it feels like it should be.
Yeah, but, you know, is it surely not more the optimism around the US taking steps ahead rather than the pound? It's more a dollar story than the pound in itself.
Yeah, the dollar certainly rose. How much further has the dollar got to go? Like in the short term, I think you've got to think about the short term, medium and long term and try and work out what it's going to do. Short term, you've seen a fairly big more positive dollar move coming out of this week. The back end of this week, but the front end of the week it was quite negative. So short term, and Nelson was talking about this, are we in a period of kind of consolidation right now? Yeah. Ultimately, though, the trade is for more dollar weakness coming down the pike towards us. The pound sits kind of somewhere between the euro and the dollar. Where does that ultimately leave it? Well, I think normally it would leave it kind of somewhere in the middle, but I think with a slightly more hawkish Bank of England, the pound may actually have more positivity behind it going forward. Negative for gilts, positive for the pound. In some ways, that's not great news for the UK economy and not great news for the government either.
And that's just the monetary policy of this all. We didn't even talk to Elsa about the fact that euro sterling may be in focus. It's simply as a function of a trade deal and softer relations with the UK and not so much with the EU. That's the bond market story. Let's go back to the equity market here and talk about one of the major earnings stories coming out this morning. Commerzbank shares higher after reporting an unexpected first quarter profit beat to the tune of higher by 1.7%. We spoke to the CEO, Bettina Orlopp, about the results.
This is why we also improved our guidance for next year with respect to GDP. And given that we are financing, for example, 30% of German Mittelstand, it will also have a positive impact on Commerzbank, that's for sure.
Bloomberg's Charlie Wells monitoring all the banks for us. Let's start with Commerzbank here. Walk us through those results.
I mean, Kriti, you can see that their CEO is clearly thrilled there, Bettina Orlopp. She's been in the job about 7 months, and she has had to contend with this takeover bid from UniCredit. She's had to navigate the elections, this new, German government coming in, which looks positive for them, but still something to navigate. And you could just see this sense of relief. This first quarter, profit, they're the highest in 14 years. There had been concerns about net interest income. This is a bank that was really boosted when rates went up, and the concern was as rates started trending down, this could be hard on them. But so far, she was talking about how they have a really well-diversified loan portfolio. They're seeing strength. They're seeing their guidance maintained in 2025, and then optimism on that German defense spending. So this is certainly the sort of report that they needed as they try to bolster themselves against that UniCredit bid.
OK, let's go to the other side of the fence. What's going on in Italy? Yeah,
so M&A wave really dominating the country, and we've got some of these key players who are in this M&A wave reporting today. We had Monte Paschi, we had Mediobanca. They beat. We've got Banca Generali coming this morning as well. And I think this is just a kind of transitional moment in Italian finance. And I think that's what everyone's going to be listening for as these executives start talking about this M&A wave. How likely does it seem that this could happen? Because this is not just about the markets. There's politics coming into play here, too, as well.
So what are we expecting from those UniCredit earnings on morning on the other side of the fence?
Yeah, so look, the year has been pretty good for Orcel. I mean, he's got the difficulty of this M&A that, he really kind of came into the position trying to orchestrate cross-border with Commerzbank, of course, but then also with BPM. Those are moving more slowly than I think a lot of people anticipated. And that's not great news, right? Because the longer this takes, the more uncertainty there is. So I think the huge focus for investors on Monday when UniCredit reports is going to be how they talk about M&A.
And already, UniCredit, and we're seeing headlines that have crossed the terminal in the last 20 minutes or so, receiving the ECB's okay for a second tranche of their 2024 buybacks. Buybacks that start immediately following the BPM bid completion. Whether or not we get that completion is a different story, but the fact that buybacks would be right off the back of it is crucial. Charlie, you've been covering all of these banks from Germany to Italy and frankly, all across the continent, arguably the U.S. as well. It feels like buybacks and shareholder returns don't usually happen at the same time as M&A. And yet, these European banks are so flush with cash, they're just kind of throwing it everywhere. And these profit numbers that you've just outlined seem like a green light to be doing more of that.
Yeah, I mean, I think at a time when net interest income, I think everyone is thinking it could come under threat, this capital allocation becomes so important for these banks, right? And so kind of how they're going to allocate that, how they're going to please shareholders, keep them coming. Because, banking has been the top performing sector in the Stock 600. But I think that doesn't mean that there's not, headwinds coming, right? Because a lot of these European banks, they've been boosted by the optimism of Germany. They've been boosted by this story of, increased defense spending in Europe, but there's also these trade tensions to contend with. So I think, it's looking great this morning. These earnings reports coming from Germany, from Italy are really solid, but it's that second half of the year that there's still questions about.
Charlie, great stuff. Thank you very much indeed. Charlie Wells on what is happening in the banking space. Let's turn our attention to what is happening in the aviation space, one of my favourite subjects. I like banking, but I really like aeroplanes. IAG announcing a major order for wide-body jets this morning, doubling down on a long-haul business with a $10 billion fleet investment to help sustain its earnings momentum. It's buying from Boeing. And significantly, actually, this morning, it is buying from Airbus. Let's bring in our aerospace reporter, Kate Duffy, to get a take on what is happening here. Kate, what's the story out of IAG this morning? Is it the fact that they've stuck to guidance? Is it the fact that actually they're seeing the front of the plane relatively full and actually the numbers look good? Or is it this commitment to the future and this slightly bigger than anticipated order for wide bodies?
I think it's fair to say it's absolutely this order that's taken us by surprise. It was the US that really teased the order yesterday, saying an unnamed British airline would buy $10 billion worth of Boeing planes as part of this trade deal with the UK. And shortly after, our team broke the news that it would be IAG, about 30 Boeing 787s and then some A330s. And IAG announced today that it was 71 aircraft in total that they're going to be ordering. So there were actually a few that they snuck in around March time. But the fresh order is 32 Boeing and 21 Airbus. And these planes will be spread across British Airways, Iberia, Aer Lingus and Level. And the majority will be going to BA in total. This was widely expected. You know, Gallego, the CEO, he did say in the last earnings that he was looking to buy more wide bodies. But yeah, it was a really exciting evening yesterday to report on.
Well, where you've got a carve-out for Boeing in this US-UK trade deal, morning, Kate, is that a signal that there are going to be more carve-outs for Boeing in the, say, US-China, US-EU deals going forward? Is that clearly a priority for the US?
Potentially. I mean, the order marks a huge win for Trump and Boeing. And since the tariffs have been announced, you know, the aviation industry has been quite concerned about how they'll fare, given aerospace parts are sort of a major component of US exports to the EU and sort of beyond that as well. And both numbers of carriers, both sides of the transatlantic, have said that they're not going to accept additional tariff charges on their planes. So yes, this could facilitate more orders for Boeing potentially, but we're yet to see.
Kate, do you think Louise had already got this order lined up? We saw all obviously the sound and fury around yesterday, and as you say, it was an exciting afternoon. But nevertheless, these orders take a while to negotiate, and I'm assuming that they've probably been a long time gestating, and IAG have thought about this quite a lot. Are there extra Boeing aircraft in here as a result of the trade deal, or was this an order that was going to get announced at some point in the relatively near future? In fact, on a day of IAG reporting corporate numbers, probably the right time to do it?
Yeah, it's absolutely good timing. I mean, Gallego said on the call earlier this morning that it was a long time coming. The order started a long time ago, so definitely good timing for both sides of the coin.
OK. Kate, we will leave it there. Thank you very much indeed. Kate Duffy, our aerospace reporter, joining us in London. Exciting afternoon, trying to work out who was going to be buying what and which airline it was likely to be. It was probably always likely to be IAG that was making this kind of scale of an order coming through from Boeing. But it is, so it's really significant. Two things that really stand out today, one of which is the North Atlantic actually is doing OK. Yeah. Which actually the data that we've seen maybe suggests that actually fewer people are flying to the United States and vice versa. So that's quite interesting as well. But the front end is holding up as well, which is a really useful consumer signal. The high-end consumer is still spending, and Sir Tim Clark was saying the same thing at Emirates. People are switching to the front end of the aircraft, which is quite a positive sign for what happens in terms of the consumer story, Lizzie.
Well, coming up on the programme, President Trump hails a, quote, historic trade deal with the UK, but the details leave some disappointed. We're going to get the view from John Alty, a former UK Director General for Trade Policy. This is Bloomberg.
This is a maxed out deal that we're going to make bigger, and we make it bigger through growth. I think it's going to be something very special for UK and special for the United States.
We've agreed the basis of a historic economic prosperity deal, and that is a deal that will protect British businesses and save thousands of jobs in Britain. Really important, skilled, well-paid jobs.
The UK Prime Minister and the President Trump hailing yesterday's announcement of a trade pact, framework, deal, whatever you want to call it, between their two countries. It's taken 5 years to negotiate, but it does fall short of a full and comprehensive deal. Let's get more now with John Alty, who knows a thing or two about trade. He's senior advisor at Pagefield now, but previously he served in the UK government as Director General for Trade Policy at the Department for International Trade. John, really good to have you with us around the table. How do you see this deal? Is it actually meaningful? Is it just one step forward after 2 steps back?
I mean, it's really important for the sectors such as cars and steel, which were facing very high tariffs. It's quite limited in its scope, and obviously both sides are saying that it should be the start of a wider negotiation. So we look forward to seeing that. In terms of whether it fully recovers the position, no, not the position before Trump, but given Trump's view on trade, you know, you have to be realistic.
I mean, you were at the Trade Department from 2016 to 2021. I hate to, you know, bring it up, but there wasn't a trade deal with the US in all of that time. What made the difference? Can Starmer be taking credit for this personally? Does it vindicate his kind of softly approach with President Trump?
Well, I'm sure, I mean, it's the first deal the Americans have done. So, you know, you should be able to draw some positive conclusions from that. I mean, in terms of the previous Trump administration and the negotiations then, they were far more wide-ranging, and they started very late in Trump's presidency. So they started, you know, 8 or 9 months before he left office. To do a trade deal in 8 or 9 months, a comprehensive trade deal, is pretty difficult.
OK, which is interesting. So what is the usefulness of what we've just seen out of the UK in relation to the rest of the world? There is this expectation that the White House is going to be doing trade deals with around the world, with lots of different countries, and you're saying that 8 or 9 months is an awfully long time, is an awfully short time to get a trade deal done. How long does it take to get a trade deal done?
Well, it depends on the scope of the trade deal. And,
OK.
You know,
how long will it take to get a trade deal done between the United States and India, or Japan, or South Korea?
Well, I mean, often these deals take years. I mean, India in particular has been negotiating for over a decade with the European Union. The EU is also negotiating with Mercosur, that's Latin America, for about 25 years. So it depends on political will, frankly.
Right. And going into this weekend, therefore, with China, what shall I expect? What shall I be looking for in terms of what we should get out of that?
I mean, I would be very surprised if I look to be surprised, maybe, but I'd be very surprised if at this first meeting you get more than a sort of indication of the mood music, and is this going somewhere, or are they flouncing out? I mean, both of those are possible.
Well, John, so much from the part that we discussed this earlier, the part of the UK-US trade deal that stuck out to me, even if it was just an early framework of this, was the fact that you are now seeing potentially barriers of US exports to the UK pulled down, whether that's in agriculture, whether that's in exports, etc. You mentioned India and the EU. India's #1 issue has always been this massive protectionism to support and to protect its domestic economy. I think the biggest, for me, I always remember my parents, for example, talking about there not being an IKEA in New Delhi, and that's a great example of not letting those kind of European companies in. Donald Trump has a manufacturing-first trade agenda.
Yeah.
How important is it that trade leaders, whether it's from the European Union, the UK, India, or whatever, come out and say, from the get-go, here's what we're going to buy from you?
Well, I think it probably is important. I mean, I thought one of the intriguing points was the order of the Boeing aircraft, because it's, you know, that's an order by a private sector company. It's not the government buying, but it's obviously being coordinated to some extent, and that is exactly what I would expect countries negotiating with the US and Donald Trump to be doing.
But it's interesting. So I suspect that the CEO of IAG was already going to order those aircraft. Like, how much of this is real, and how much of this is dressing up for the cameras and trying to get some sort of positive momentum? What effect do things like that have? Even though they are completely unrelated, they obviously have a sort of halo effect.
Well, whenever you see ministers going abroad, never mind concluding a trade agreement with a delegation of businesses, they always want to announce, like, billions of pounds of deals.
Yep.
Those deals were probably going to happen anyway. They've probably been announced already. But it's part of the choreography. So, and, you know, VE Day, the choreography is important, I think, to the president and probably to all politicians.
So what can the U.S. offer the rest of the world here then, in terms of actual goods purchases? I'll take the services, I'll take the taxes, I'll take the intellectual property out of it for right now. In terms of actual goods, what does the rest of the world want from America?
Well, I mean, there are restrictions in the US. They don't so much tend to be tariffs, although there are some products with high tariffs in the US, like light trucks, etc. But, you know, there are restrictions on maritime trade. There's arrangements about their intellectual property rules, which are problematic for the UK music industry, for instance. So that's why I said these are the sort of things that do not get sorted out in 4 weeks. They can take 4 years, but hopefully they can be done quicker.
Yeah, can I talk about one of those things that hasn't been sorted yet, the digital services tax?
Yeah.
What should the UK be giving away to the US, on the flip side of Kriti's question, for more lenience here? Because, you know, we can't really afford to lower or abolish the digital services tax, can we?
Well, I mean, that's obviously a question for the government, and it would be very politically unpopular if they did abolish it. I mean, it's meant to be an interim measure but for an international agreement, but the international agreement doesn't look like it's ever going to come. So I think they will be, I mean, it's interesting that nothing was done on that. But there are other things. I mean, we still have a 10% tariff on US cars coming into the UK, just as the US has a 10% tariff on us. There's no reason we couldn't reduce that tariff. We still have very high tariffs in our agriculture sector, which is a sensitive sector, but as we've seen, the government has opened that up a bit, as long as we keep our regulatory system, you know, our safety standards. So Donald Trump seems to be focused on goods mostly, so I would suggest we should focus on the things that will allow more American goods to come into the UK.
What about agricultural goods? Because we were talking earlier about lowering the barriers, tariff barriers, but as I'm sure you did last night, dug into the weeds of the non-tariff barriers, do you see cause for concern aligned with what the papers would be worried about, which is hormone-fed beef and chlorinated chicken?
Well, again, the government's not changed anything there, and the previous government was saying it wouldn't change anything there. Obviously, this also links to the negotiations with the EU, because if we want a better veterinary arrangement, we want to make it easier for our exports of food and drink to go to the EU, we do need to stick pretty much to the EU standards, which don't allow hormones or chlorinated chicken. So I don't think that's going to change, but tariffs is a different matter.
Thanks for stopping by to see us. Thanks for updating us. Thanks for the knowledge and the experience of what happens in these kinds of negotiations. John Alty, Patriot's Senior Advisor and former Director General of the Trade Policy at the UK Government. Thank you very much indeed. Coming up, Moody's ratings warning of rising risks as retail investors flock to private markets. We'll talk about that story next. This is Bloomberg.
Our clients globally are wondering whether they need to back off on how much exposure they have to the U.S.
It's created a significant opportunity so far.
Find better opportunity to invest than the weaker credit at this stage of the business cycle.
We had this dry powder to step up and provide liquidity when other people couldn't.
We have $13 billion of dry powder. Very much open for business, very interested in providing that capital.
Private credit comes up in every meeting that we have here at the conference, and there are certain slivers of the private credit market that would do quite well in an area of lower growth or uncertainty.
They all sound really positive, don't they? Really positive. Attendees at this week's Milken Institute Global Conference taking place in California, giving us a sense of how the credit markets see the world right now. Equity-like in some ways, you could argue, in terms of the positivity that maybe is coming through there. Mark Pinto, Global Head of Private Credit at Moody's Ratings, joining us around the table Good morning.
Good morning.
You've had a conference here in London.
We did, absolutely.
What was the mood like there?
You know, it was pretty optimistic, I would say as well. But one interesting thing is we asked the audience when they came in, would the volatility that we're all experiencing today, would it be beneficial for private credit or would it potentially be damaging? And the audience was split right down the middle. So,
is that a surprise?
It was to some extent, but I think that it might have reflected the audience in the sense that I think a number of the people in the room were fairly familiar with what's going on in private credit. And there was probably a big swath of people who are kind of looking at this for the first time. And I think they're probably a little bit more cautious.
Everybody's... so it's interesting, actually, you talk about this split within the room, because I think there's a kind of... There's a sense of a split within the market, and Moody's highlighted this this week, that there is this... You have the situation in private credit where retail is starting to come in.
Yes.
There's this kind of idea that retail is starting to become a bigger force within this space. But on the other hand, you've got quite lumpy assets. And so you're ending up in what is a classic within financial markets of kind of a short-term liquidity story, which retail thinks it has, and a longer-term liquidity that the industry thinks it has. And the two aren't necessarily seeing eye to eye right now. How big a risk is that?
It is definitely a risk. It's interesting because when the private credit sponsors started talking about the retailization, if you will, of this market, there were, in my own mind, we thought, well, if this happens, it's no longer a question of if, it's when. And the important thing, as you mentioned, is how, because we're dealing with illiquid assets, so you're going to need more transparency, you're going to need more education. I think that's key.
How does that set up the relationship with some of the traditional banks that have always been kind of the key lenders, at least pre-GFC? And it feels like they've taken a step back. Private credit has come in, but the risk you run with that, and I think Jamie Dimon had made a comment like a year ago comparing the private credit space to the mortgage crisis, the risk you run with that is the illiquidity of all of it, that if something were to go wrong, the banks can maneuver faster than these private credit players. How fair is that?
I don't know that that's completely fair, to tell you the truth.
Correct me, please.
Yeah, sure. So the private markets are very agile. They're very creative, and they tend to step in when the market dislocates. So they've had a number of growth spurts over the last decade or so. So we can go back to the great financial crisis. Banks pulled back. Private markets froze up to an extent. Private credit leaned in. We saw the same thing during COVID. And we saw the same thing during the spring of 2023 when we had Silicon Valley Bank and Credit Suisse had issues here. So private credit markets are agile. And one of the things they have that's a big difference is that they're funded with long-term deposits, if you will, locked up capital. And so therefore you don't have that asset liability mismatch as you actually do within the banking system.
Is private credit, for that reason, that agility you hone in on, can it come to the rescue of some of the deal gluts we're seeing in private equity?
It's an interesting question. They're definitely leaning in right now. I thought when we first saw the volatility that we might see the private credit lenders also kind of sit on the sidelines. Many of them have jumped into the pool. There's still some on the diving board, and there's still some around the edges, but they've jumped in, and they're doing deals today.
How risky is that, though? How risky is tying private credit's fortunes to private equity at the time when people are pulling back from the capital markets, not in?
Yeah, they tend to be counter-cyclical investors, and they tend to be very sophisticated, very smart. They, I think, are good risk assessors. And again, because they're not as regulated as the banks, they have more agility than the banks do today. In fact, you know, as I mentioned, risk is on the move. We're talking trillions of dollars. It's moving out of banks and into insurance companies through the private credit sponsors, into pension funds, and as we were talking just a minute ago, into the hands of retail investors.
But how much is that pivot because of a necessity, and how much is it actually because of innovation in your space?
It's a combination of two. Like water in nature, capitalism will find a way. So as the banks have become more and more regulated, and there are financing needs in the market, the private credit lenders have started to grow. I think about it as a balloon. You push it down over here, it pops up over here.
OK. And then amidst all of this volatility, how are you kind of reshuffling your portfolio?
I mean, the way we think about it as a rating agency is we're looking for the risks that may be emerging. One of the things we've been talking about with investors as well as regulators is, does private credit represent an increase in systemic risk?
Yeah.
It's certainly becoming more systemically important, but the question is whether it's actually adding risk, or is it mitigating some risks in the market?
We're not going to know until we've been through a cycle. And isn't that the case here, that actually what we need to do is stress test the model and see what happens?
Well,
that's where the risk... we thought that we disaggregated risk going into the GFC. We thought that it was all great, and central banks talked about this, and we had disaggregated risk, and as a result of which everything balanced itself out.
That's the exact argument that Jamie Dimon is saying is going to happen again. He's comparing it to the housing crisis. Why is this different than the housing crisis?
Well, I would say, first of all, again, you've got locked up permanent capital. So you have a run on the bank. Run on the bank is not good for the economy. You don't tend to have a run on the private lender. You don't tend to have a run on an insurance company.
But isn't this where the mismatch comes in, that you've got retail investors who think they have got liquidity?
So we're at early days in terms of retail investors getting into this. And that's why I was mentioning you're going to need education, you need more transparency.
Do you think the industry's doing a good job on that education at the moment?
You know, one of the people who was at our conference the other day was a big asset manager, and they were talking about, particularly for high net worth individuals who are fairly sophisticated investors. Today they have about 5% of their overall portfolio in private markets. This gentleman was suggesting that over the next several years, that will double or triple. So you could have somewhere on the order of 10 or 15% of a high net worth individual's portfolio. This has not yet reached Main Street.
Yeah.
But the private sponsors are salivating at, for example, in the U.S., you've got 401ks, $8-9 trillion worth of money.
Yeah.
Why not get some of that? If you put that into, let's say, the target date fund sleeves, you're going to need education, because that can be liquefied. You can get money out of your 401k for hardship, for your first-time home buyer, for a number of different reasons. So you need that education. So to answer your question, it hasn't started yet, per se, to really get to Main Street. It's still in the hands of Richie Rich. Richie Rich has got a little bit of private credit, but not a lot of other people.
And probably is reasonably well educated, but maybe, as you say, as we spin it out, we're going to watch it very carefully.
We have to watch this super carefully.
Nice to see you. Thanks for stopping by to see us.
Thank you. Thank you.
So, Global Head of Private Credit, joining us from Moody's Rating. Thank you very much indeed. It is Friday. The weekend's going to be busy. There's a lot going on this weekend. You've got Liverpool-Arsenal. It could be a tough week for Arsenal. Sorry, Prime Minister. But Bloomberg Originals has taken a deeper dive into the English Premier League. As owners struggles with rising costs, clubs are embracing American luxury to boost revenue. But some fans are a little worried that the pursuit of profit is leaving them, the fan, behind.
The Premier League is the pinnacle of club football. The theatre, the tension and the talent are unrivalled in a league which boasts nearly 2 billion followers worldwide. And yet...
Now, I'm not sure what would make you more miserable, being a Manchester United fan over the weekend or holding the stock this morning.
There's loads of losses. If we look at the top 5 leagues of English football, more than half of them are technically insolvent.
Just look at how many clubs in the Premier League lost money in 2023 to 2024. Only a handful of them actually managed to turn a profit.
I've had executives say to me, we're looking like behind the sofa, we're looking everywhere to get, a few pounds, dollars or whatever.
They're also looking overseas.
One of the things that English football clubs have started to realize on the backs of what's been learned here in America is that people are willing to pay for experience.
But some fans are worried they're being left behind.
To the corporates who are running our clubs and making the decisions, we are just customers and we can only be thought of in that way.
As clubs explore new opportunities to keep the money flowing in, does English football need greater American influence to keep it afloat? And if so, what might that mean for the future of the beautiful game?
Is it sports or is it entertainment? That is the challenge that I think certainly all European sport, certainly all UK sport, has got to deal with right now and try and figure the answer to that. Look at rugby, look at what's happening in cricket as well. All of that happening at this moment in time as we try and get that balance right. You can watch the full documentary, Bloomberg.com. It's also available on YouTube. Well worth a watch. As I say, Liverpool-Arsenal, Sunday, 4:30. It's been a tough week for Arsenal.
Excuse
Prime
me.
Minister.
Real Madrid, Barcelona. Hello.
Yes, you've got the Champions League coming up. I'm just talking about English football here, which has had a tough week. Arsenal being knocked out by PSG. It was the real game was the Barca game where they got knocked out by Inter. That was amazing. My son was shouting at the television. I was trying to go to sleep. All he could hear, he's meant to be doing his GCSEs, but he was shouting at the television. It is a busy weekend coming up. We've got lots going on.
Sport aside, can I tell you that it's the 25th anniversary of the Tate, a cultural thing to be happening at the weekend. There's some relief.
Yeah, okay. If you want to do that.
If you don't watch sports, you go to the Tate. Exactly. Apparently.
Okay. Well, great. There's other things happening as well. You've got the Pope's first mass is this weekend, isn't it?
It's happening today, I'm told.
Is it told
at
today?
10 a.m. UK time, 11 a.m. local. At the Sistine Chapel. I think he's got the most exciting plans of us all, perhaps.
He's a White Sox fan, though, isn't he?
I don't know. I don't know his sport affinities, Guy, but
I'm told he is a White Sox fan.
We're gonna have to do some research, maybe invite him.
Ice hockey this weekend. The ice hockey's going to be
Guy,
amazing.
leave me alone. I don't want to talk about sports anymore.
Okay, sorry.
Let's talk about what's happening this weekend. Of course, we are going to be exploring all these things. I'm sure sports will be on the agenda. You can get that edition of the Bloomberg Weekend newsletter. Deeper analysis, feature pieces, profiles, unique insight, all that fun stuff on the weekend newsletter. Be sure to tune in. But I think the real highlight of this weekend, sports aside, culture aside, is what's going on in Geneva. Do we get some sort of reprieve between the United States and China?
Well, everybody wants to think that they've got the upper hand going into these talks. Interesting to look at the China data this morning. Actually,
not very good.
Exactly. Well, your Chinese exports rising more than forecast. You had bad US export data, trade deficit. Surely that gives Chinese the upper hand in this.
Yeah, if you look at the Chinese data, it got better for the rest of the Asian countries. I'm assuming that's reshipments. So stuff's going into other Asian countries and then coming out of other Asian countries and going to the United States.
Exactly.
So
you can make up the losses.
You could balance it out. But how long can you do this? This is still early data. Take a look at what's on the water right now, and you've seen a massive drop in the number of ships coming out of China and going across the Pacific. I think that is a crucial piece in all of this. So yeah, I think it's going to be good. It's going to be really interesting. I'm going to be watching the sport. There's a lot of great sport to be watching, but I will be paying attention to this, and I think Monday morning will be dominated by this. It's the symmetry of this is fascinating. How much good news is priced into markets already? Yeah. Is there the risk that nothing happens and you get the bad scenario that Mark Cudmore was talking about coming through on Monday morning? That's the one to maybe watch out for.
Is that the positioning story that is perhaps a little skewed this morning? I'm looking at these equity indexes here that aren't moving to the upside that much in Europe. Even futures in the States, higher by 0.1%. The dollar weaker, but by marginally. People are in wait-and-see mode. This is a cautious market.
OK, the Reykjavik Economic Conference, ECB and Fed officials are going to be speaking there. Fran's going to be there as well. Francine Lacroix interviewing some of the biggest names. John Williams is going to be there. I think we're going to be having a conversation with him, or Fran is. Can't wait to hear what he has to say about what is happening. Talking of which, the Pulse is next, and this is Bloomberg.